In 2023, some major U.S. banks like Bank of America, Goldman Sachs, and Morgan Stanley are facing what experts are calling an unprecedented financial crisis. Bank of America's strategists wrote a note to clients stating that banks are likely paying to protect their cash holdings from further declines and to safeguard against future runs on deposits. Goldman analysis forecasts that the S&P 500 will underperform in October and generate lower returns over the next 12 months. However, it doesn't provide specific quotes or statements from Goldman Sachs. Morgan Stanley is mentioned as having released a note pointing to trouble in equity markets, with Chief Investment Officer and Chief U.S. Equity Strategist Michael Wilson discussing reasons for his concerns about a potential double-digit crash in the S&P 500. U.S. banks in peril. The backbone of any country's financial system is its banks, and the United States is no exception. These financial institutions, which play a central role in the economic machinery, are currently facing a set of challenges that experts believe could lead to a severe crisis. At the heart of this issue are several major U.S. banks, including the likes of Bank of America, Goldman Sachs, and Morgan Stanley. These institutions, which have long been considered stalwarts of the financial sector, are now grappling with a range of problems that threaten their stability and, by extension, the broader financial system. Concerns reverberating in the stock market. One of the primary areas of concern that has captured the attention of financial experts is the stock market. These experts hold a deep-seated belief that the stock market is currently overvalued, meaning that stock prices have soared to levels that exceed what would be justified by prevailing economic conditions. This overvaluation, they argue, could sow the seeds for significant financial turmoil. Understanding the vulnerability of the stock market. Concerns about the stock market's vulnerability stem from several key factors. First and foremost, there's a looming sense of economic turmoil, signaled by various economic indicators that are flashing warning signs. These indicators, which provide insights into the health of businesses and manufacturing, are showing signs of turbulence that haven't been witnessed in recent history. One major red flag is the slowdown in consumer spending, which plays a vital role in driving the economy. When people tighten their belts and reduce their spending, it sets off a chain reaction. Businesses feel the pinch as their revenues decrease, leading to potential layoffs and reduced investments. This domino effect ultimately impacts the stock market, as companies' financial health is closely tied to their stock performance. Another concerning factor contributing to the unease is the rise in delinquencies. More and more individuals are finding it challenging to meet their financial obligations, resulting in higher rates of loan delinquencies. This growing trend has the potential to destabilize the banking system as a whole. Banks rely on borrowers to repay their loans on time, and when delinquencies rise, it puts stress on these financial institutions. If banks face mounting financial difficulties, it poses a significant risk to the stock market's stability, as they are fundamental players in the overall financial ecosystem. The commercial real estate conundrum. Another significant area of concern that demands attention is the state of the commercial real estate sector, which includes various types of properties like office buildings and shopping centers. Within this sector, several problematic issues have come to the forefront. Firstly, there is a troubling trend of falling occupancy rates, meaning that a concerning number of commercial properties are sitting vacant. This situation is alarming not only for property owners, but also for the banks that provide loans to finance these properties, as it puts pressure on the ability of property owners to meet their financial obligations. Additionally, another concerning factor is the surge in interest rates applicable to commercial properties. These increasing interest rates are creating financial challenges for property owners, as they find it progressively harder to manage their financial responsibilities related to these properties. The rising cost of borrowing can squeeze property owners' cash flow, leaving them with fewer resources to cover operating costs, loans, and other financial commitments. Furthermore, experts express unease about the potential erosion of property values in the commercial real estate sector. The combination of falling occupancy rates and rising interest rates could result in substantial losses in the value of commercial properties. This decline in property values has broader implications, as it can further strain the overall health of the financial system. Depositor confidence and the threat of bank runs. Depositors are like the lifeblood of banks, entrusting their hard-earned money to these financial institutions. But when depositors start to worry that their money might not be safe in a certain bank, they can quickly rush to withdraw their funds. This situation is known as a bank run, and it can be incredibly damaging. Imagine a crowded exit at a theater when there's a fire alarm. That's the kind of chaos a bank run can create. Now, smaller banks, especially those focused on specific regions, are in a particularly precarious position when it comes to depositors losing trust in them. These regional banks are worried that their customers might suddenly panic and start pulling out their money. To prepare for this possibility, these banks are taking preventive actions to secure their finances and assure their customers that their money is safe. It's like a local grocery store, making sure they have enough supplies during a snowstorm, because they know their customers rely on them. Regulatory responses. To address the mounting concerns surrounding the financial system, U.S. regulators are contemplating the implementation of new rules and regulations for banks. One of the key proposals under consideration is the requirement for banks to hold more long-term debt. This debt would serve as a financial buffer, capable of absorbing losses in the event that the government intervenes to take control of a failing bank. These regulatory measures are being explored as a means of safeguarding the interests of the general public should more banks face insolvency. It is akin to having an emergency fund for banks, the domino effect and its implications. A concerning scenario in the current financial landscape is the possibility of a domino effect. Imagine one bank facing severe problems and eventually collapsing like a falling domino. This single event could set off a chain reaction where other banks also run into trouble. Such a chain reaction could lead to a widespread financial catastrophe with profound consequences. The ramifications of this domino effect are substantial. As banks start failing one after another, the public's trust in the entire banking system may crumble. People might begin to question the safety of their money stored in banks, leading to a significant loss of confidence. This loss of confidence can have a devastating impact on the economy. It can cause a recession, which is a period of economic decline marked by reduced business activity, job losses, and a drop in consumer spending. In the worst-case scenario, it could even escalate into a full-blown financial crisis akin to the global financial meltdown of 2008. This crisis would involve severe disruptions in financial markets, widespread bank failures, and a deep recession affecting people's livelihoods, savings, and investments. Conclusion and prudent measures. In 2023, concerns are mounting about the financial stability of U.S. banks and the overall health of the stock market. These worries have caught the attention of experts and analysts who believe that a crisis could be looming on the horizon. This situation underscores the need for individuals to be aware of these concerns and take proactive steps to safeguard their financial well-being. One crucial strategy individuals can adopt is diversifying their investments. Diversification means spreading your investments across various types of assets, such as stocks, bonds, real estate, and more. The goal is to reduce the risk associated with any single investment. By doing so, you can better protect your portfolio from the potential downturns in specific sectors, like the stock market. Diversification is a prudent approach to managing risk and ensuring that your financial future remains secure. Another essential aspect of financial preparedness is actively monitoring your financial health. This involves keeping a close eye on your income, expenses, and overall financial situation. It's especially vital during uncertain times when economic conditions may change rapidly. Responsible management of debts and loans is a key component of this monitoring. Ensuring that you're making timely payments and not taking on excessive debt can help you maintain your financial stability, even in challenging economic environments. Additionally, staying informed about economic developments and financial news is paramount. knowledge is a powerful tool when it comes to making informed financial decisions. By staying up to date with the latest economic trends, policy changes, and market movements, you can adapt your financial strategies accordingly. Being well-informed empowers you to make prudent decisions about investments, savings, and other financial matters. While these concerns about U.S. banks and the stock market are indeed significant, it's essential to recognize that the financial landscape is dynamic. Regulatory authorities and financial institutions are actively taking measures to prevent a potential crisis. However, this does not diminish the importance of exercising caution and preparedness in your financial decisions. For more such videos, share and subscribe to the channel.